Hi, I'm Rebekah Marlow, and for Case 2, I've decided to do Chapter 10 over East Coast yachts. Alrighty, let's get into some background information. So we have just accepted a job at East Coast Yachts, and Dan Irvin has informed us about the company's 401k plan, which has several options for investments, most of which are mutual funds. So Bledsoe Financial Services is the 401k plan administrator, and investment options offered for employees include company stock, the S&P 500 index, the small cap fund, large company stock fund, bond fund, and money market fund. Alrighty, now we're going to look at the questions that we're going to be answering. So first we're going to see what the advantages mutual funds offer compared to company stock. We're going to look at the ERA from employee matching and what conclusions can be drawn about these matching plans. Look at the advantages and disadvantages of choosing the Bledsoe Large Company Stock Fund versus the Bledsoe S&P 500 Index Fund. We're going to look at why we would ever want to invest in the Bledsoe Small Cap Fund when it's more volatile. Does this fund having the highest expenses affect our decision to invest in the future? And then we're going to calculate the Sharpe ratio for 4 of our funds in the company stock, and we're going to see how appropriate the Sharpe ratio is for the assets as well as when we would use it. Alrighty, first we're going to look at the advantages of mutual funds over investing solely in our company stock. So first is diversification. So mutual funds, they represent a portfolio of assets and provides immediate diversification. When you purchase shares of a mutual fund, you're buying a partial ownership in a collection of different investments. So this helps to reduce the risk compared to holding stocks in a single company like East Coast Yachts. Now the variety of investment options. So the mutual fund options provide a range of investment objectives and risk levels, which allows you to diversify across different asset classes and market capitalizations. So this allows you to tailor your investment strategy according to your risk tolerance and your time horizon. Investing only in company stock limits you to the performance of a single asset. Now professional management. So the mutual funds are managed by investment professionals who make the investment decisions for the fund. So this expertise could potentially lead to better investment outcomes. Investing solely in company stock means your return is entirely dependent on the performance of East Coast Yachts. And then finally, potential liquidity. So mutual funds shares are typically more liquid than shares of a privately held company like East Coast Yachts currently is, and it's usually easier to buy and sell shares of a mutual fund than it is to sell shares of private stock. Now we're going to take a look at matching plans. So say you invest 5% and you receive the full 5% match from East Coast Yachts. What's going to be your ERA? Well, it's going to be 100% because maximizing the match equals 100% return on your investment within the year. So what are some conclusions drawn about matching plans? So the first one is that they incentivize employee participation in retirement savings. So matches are strong incentives for employees to participate because they can receive additional funds in retirement simply by contributing their own money. Next, they represent a significant return on investment. So maximizing the match alone provides a 100% return on the amount you contributed to receive that match within the year. So this is a very substantial benefit of participating in a matching plan. Next, you can just enhance retirement savings. So by providing a matching contribution, companies like East Coast Yachts, they help their employees accumulate retirement savings more quickly than if the employees were only contributing their own funds. So this significantly impacts the total amount employees have when they retire. And finally, it's just important to max out the employer match if you're able. You don't want to leave any money on the table. Working in audit and auditing employee benefit plans, I've seen the very positive effects on retirement that maximizing your match can have. And so maximizing your match helps to better set yourself up for success when you do retire. Now we're going to look at large capitalization stock comparisons. We're going to compare the Bledsoe Large Company Stock to the Bledsoe S&P 500 Index. So starting with advantages for the large company stock, the first advantage is active management. So the fund is actively managed by Evan Bledsoe. He's an investment professional. His expertise can lead to better investment decisions and performance. So now we have potential outperformance. So this fund has outperformed the market in 6 of the last 8 years. So this suggests the potential for achieving returns above the broader market due to the fund manager's active investment decisions. The advantages for the S&P 500 index, first is low expense ratio. So it charges expenses of only 0.15% of assets per year. So this low expense ratio is a significant advantage that minimizes the costs that reduce your investment returns. Next, you have diversification. So by tracking the S&P 500, the fund provides broad diversification across 500 of the largest publicly traded companies in the United States. So this can help reduce unsystematic risk. Next, historically strong returns. So the S&P itself has historically provided competitive returns over long periods. And then next, predictable performance. So the fund's performance is closely tied to the performance of the S&P 500. So this makes its returns more predictable compared to an actively managed fund whose performance depends on the manager's skills and market conditions. So now disadvantages of the large company stock fund. So with high expense ratio, it charges 1.5% expenses, so it's significantly higher than the S&P 500 index fund, and these higher expenses can erode your overall return over time. Next is past performance is not necessarily a guarantee. So while the fund has outperformed the market in the recent past, it's not necessarily indicative of future results. There's no guarantee that Evan Bledsoe is going to continue to outperform the market. Next, there's potentially higher risk. So although both funds invest in large capitalization stocks, the Bledsoe large company stock, had a 10-year standard deviation of 26.73%. This was higher than the S&P 500s. And so this higher standard deviation suggests that the return, are going to be more volatile over the past 10 years. So disadvantages of the S&P 500. So there's no potential for outperformance. So since the fund simply tracks the S&P 500, its returns will, by definition, be approximately the return of the S&P 500 minus the expenses. So it's not going to outperform the index. And if the S&P 500 underperforms, the fund's also going to underperform. Now, market risk. As it invests in a broad range of large cap stocks, the fund is subject to the overall risk of the stock market. If the stock market declines, then the value of the fund is also going to decline. Alrighty, now we're going to look at the Bledsoe Small Cap Fund. So this has higher volatility. So why would you even want to invest? Well, you have potential for higher long-term returns. So, according to our chapter, historical data from 1926 to 2012, it suggests that small company stocks have had a higher average return compared to large company stocks, although with a wider range of actual returns. So the Bledsoe Small Cap Fund had the highest 10-year annual return at 15.32%. And so while past performance is not indicative of future results, this historical outperformance is a key reason for investing in these small cap stocks. Additionally, accepting higher risk for potentially higher rewards. There's the general rule that the more volatile or risky return is, the greater the return will be expected to be. So investors that have a higher risk tolerance and a long-term investment horizon might be willing to endure the greater fluctuations in the value of the Bledsoe Small Cap Fund for the possibility of achieving superior returns over their time. Next, I have some diversification benefits. So while the fund primarily invests in small capitalization stocks, it also has the flexibility to invest up to 10% of its assets in companies based outside the United States. So this limited international exposure can offer some diversification benefits beyond purely domestic small cap stocks. And finally, small capitalization companies often have higher growth potential compared to these larger, more established companies. So investing in the small cap fund allows investors to participate in potential growth of these smaller firms, which could translate into higher capital gains over the long run. So, does having the highest expenses affect the decision to invest? Yes, it definitely affects it. So first, higher expenses reduces, the net return. So the high 1.7% expense ratio is going to directly reduce the net return you're going to receive compared to, a fund with a lower expense ratio. Additionally, there's a trade-off between potential higher returns and higher costs. The high expense ratio eats into potential outperformance, so you need to consider whether this potential for higher return is significant enough to justify the higher cost. And there's going to be an impact on compounding. Even seemingly small differences in expense ratios can have a significant impact on your investment due to the power of compounding. And then finally, you just have to consider risk-adjusted returns. While it has the highest historical return, it also has the highest standard deviation. So it's important to consider the return you're getting relative to the risk you're taking and the fees you're paying. Now we're going to look at calculating our Sharpe ratio calculation. So in order to be able to do the calculation, it's risk premium divided by standard deviation. So we are given the return and we have the risk-free rate, so we are able to calculate our risk premium below. So you take the return for each fund, subtract out the risk-free rate, and then that is going to give you your risk premium. Now that we have our risk premium, we are able to calculate the Sharpe ratio. So you take your risk premium, divide by the standard deviation, and then that will give you your Sharpe ratio. So these are all the Sharpe ratios for the 4 funds as well as the company stock. So now we're going to take a look at how appropriate the Sharpe ratio for these is for these assets. So first, it is relevant and commonly used. It explicitly takes into account both the expected or historical return of investment and its associated risk as measured by standard deviation. So this allows for comparison of different investment options on a risk-adjusted basis. For instance, a fund with a higher return but also much higher risk might not be as attractive as a fund with a slightly lower return but significantly lower risk as reflected by a higher Sharpe ratio. The sources provide all of the necessary data to calculate the Sharpe ratio for each investment option. So all the data is available for calculation, so it's very relevant as there. And then finally, it allows, for a comparison across different asset classes. So it offers a variety of investment options and that provides a standard metric to compare the risk-adjusted performance of these different asset classes. There are some potential limitations to consider. Historical data as a predictor of the future isn't necessarily always accurate. It's not going to guarantee future results. Expected versus historical data for the company, it's just estimates and they're inherently less certain than historical data the expected is. Then you have standard deviation as a measure of risk. It captures a dispersion of actual returns around the security's mean. However, it doesn't distinguish between upside down and downside volatility, which some investors might view differently. We're going to look at kind of like the appropriateness of the risk-free rate is kind of a limitation. it can be debated depending on investors' time horizon, their goals, and then it doesn't take into account some other important factors that might influence your investment decisions, such as expense ratios and tax implications or individual investor specific financial situation and risk tolerance. Alrighty, now we're going to look at when you would use a Sharpe ratio. So kind of like we did for East Coast Yachts, you can use it to compare different investment options within a portfolio. So you can use it to see which ones have historically provided better returns relative to their risk. You can use it to evaluate the performance of a fund manager. So since mutual funds have these fund managers that make investment decisions, this ratio can be used to assess how well a manager has generated returns relative to the risk they have taken in managing the fund. We can also use it to make asset allocation decisions. By comparing the Sharpe ratios of different investment options and asset classes, the investors can make more informed decisions about how to allocate their assets to achieve the desired level of risk and return. And finally, you can use it to assess the impact of risk on return. So the Sharpe ratio explicitly considers the risk premium, which is the added return for taking on risk above the risk-free rate. And so by dividing this premium by our standard deviation, the Sharpe ratio quantifies the return per unit of our risk.